Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategist. Today, we are lucky enough to be joined by Chief Market Strategist and Head of Technical Research, Chris Verrone. Chris, how are you doing today?
I'm doing great, Ross. Thanks for having me.
Yeah, good to talk to you. A lot going on. I want to get to this big rally in equities, but I think we need to start with the thing that's causing a little bit of turmoil in markets and maybe in DC today, which is the move in yields. We've seen this big move in 10-year yields, 30-year yields higher. You wrote today that the market kind of needed an excuse to consolidate. How much is this just an excuse for the market versus how much you actually get concerned about yields through these key levels?
Well, I think certainly the move in yields will probably embolden the equity bears. And frankly, that's kind of helpful from a sentiment standpoint here. When you look at the 10-year yield, let's start there. The reality is, over the last basically 3 years, the only correct call on 10-year yields has been no call. They've been in a big range, about 480 on the high side, roughly 375 on the low side. We're pushing 460 this morning, so getting closer to the high end of that range. I would be skeptical that they're going to meaningfully push through 480 or 485. Where you have seen the breakout in yields is really on the long end. 30-year yields are through 5%, but it's not just a US story. So it's hard to say, oh, it's only because of the tax bill or it's about the deficit. You're seeing German 30s do something similar, certainly Japanese 30. So there's a global move to this. It's not just a US move. I think what's interesting in the equity market, if you look at where the relative weakness is coming from, it's coming from groups like housing and home building and REITs that are very rate sensitive. So it seems to be relatively localized. I take some comfort that the move here in yields is frankly not disrupting cyclicality. Industrials have been very good, financials have held their own globally. So I'm a bit more sanguine, probably about the move in yields, certainly relative to what the financial media has been telling us the last 24 or 48 hours.
Yeah, that's great context. And I want to kind of grab onto that note about cyclicality because one of the things about this rally over the last 6 or so weeks off the April 8th lows is one, the breadth has gotten really impressive. And I want you to talk about that. You'll have been watching the 20-day high number, which is important. And then just what's been leadership, which is cyclicality. And that's good for the kind of tenor of the bull market. Can you expand on some of those items and why this looks a little more robust today than maybe it did 3 or 4 weeks ago?
Well, I think, Ross, to discuss where we are today, you kind of have to think about where we were April 3rd, 4th, 5th, 6th, 7th. And we held, I think it was that Sunday night, maybe April 6th. We did a Sunday night conference call with a couple thousand clients. And we basically said, listen, sentiments at an extreme, 48.50 on the S&P discounts a lot of bad things happening. You have price extremes, indiscriminate selling. I think at one point Monday morning, you only had about 10% of issues above their 200-day moving average. That is a historic signal. I mean, that puts you in the category of March 2020 or fall 2008. No matter what you think strategically, you generally rally from that condition. And that was our view in early April, that we would get a good rally. I had thought at the time maybe 56, 5,700 would kind of mark the top end of that move. But as the rally matured, particularly the last 3 or so weeks, the character of the events, frankly, got better and better under the surface. You got the very big expansion in 20-day highs, as you note. Historically, when you're getting, call it more than half of the S&P making a 1 month high on any given day, your forward returns over the next 6 months tend to be well above average. So we can put a check next to that box. And then I think importantly, when you look at the leadership fabric of the market, you had the return of some pretty pro-cyclical leadership, particularly through the lens of the industrials, the machinery stocks, and that was global there as well. At the same time, you had the defensives really surrender a lot of their relative advantage from February and March and early April. So I've kind of grown more comfortable as this market rallied with both the internal character of it and the leadership. I think that speaks to the idea it may be more durable over the longer term. The trouble is the tactical call. We're up 20+% over a month and a half. You consolidate from that. And as you noted, and we wrote this morning, maybe yields are the short-term excuse to consolidate from that here. I still think 5,500, maybe 5,550 would be the worst we do on any type of a pullback here. I would buy it. I think you got to focus on where the leadership is. Certainly, industrials, financials, parts of consumer discretionary, not all of it, stand out in that regard.
Yeah, absolutely. I mean, I think the market's response to the Moody's headline over the weekend about the downgrade kind of shows what you're talking about, which is just looking for any reason to kind of give a little bit back. But I like the message a lot, a little bit more sanguine on rates than the market, and like the character of this bull rally so far. So, Chris, thank you so much for the time as always, and we'll look forward to talking to you again soon.
My pleasure. Talk soon.